Chapter 10. How to Implement the Dividend Strategy. The investor's chief problem, and even his own worst enemy, is likely to be himself. Benjamin Graham. So far, the book has been more about why the dividend strategy is so powerful. But how do you go about implementing it? You have a few options. Dividend funds. If you're just starting out, managing a portfolio of individual dividend stocks probably doesn't make sense. The commission charges to buy a stock currently run from $5 to $10. To own a diversified portfolio of 10 to 30 stocks, you're going to pay at least $50 to $150 just to get started. If your account is only $1,000, those charges are going to subtract 5 to 15% from your initial investment. It will take you years to overcome those costs. If you have $10,000 or less to invest, you should start by purchasing some dividend-focused mutual funds, or ETFs. My personal favorite is the Vanguard High Dividend Yield ETF, ticker symbol VYM. You'll own approximately 300 stocks with a nice combination of high yield, dividend growth, and strong performance. While you're buying dividend funds and adding to your account each month, I would suggest reading more books about stock selection. Start with Benjamin Graham's Security Analysis. It may be a bit technical at first, but it will provide a solid foundation for you. A word on 401k assets. One reader asked me about implementing a dividend strategy in her company's 401k. If you have money in a 401k, 403b, or other retirement account sponsored by your employer, you probably won't have access to a dividend fund or individual stocks. You are limited to the menu of mutual funds offered by the plan. In this situation, your best bet is to find a low-cost fund that tracks the U.S. stock market. This is most likely going to be an S&P 500 index fund. If you're having trouble with your options, ask around for a fee-only financial advisor. They may be willing to help you identify a good option for you. If you have an old 401k at a previous employer, you can do an IRA rollover, which simply means moving money out of the old account and putting it into an IRA in your name. This will open up your investment options to allow you to invest in anything you want. As your portfolio grows larger, and so does your knowledge, you may want to start buying individual stocks. This is by no means an exhaustive how-to. This book is not focused on stock selection. My goal with this book was to give you a short, easy-to-read introduction to dividends. There are other books out there that would be helpful for you with respect to stock analysis. In this chapter, I'll give you a few thoughts that I hope will get you started. 1. Focus on dividend growth more than dividend yield. Too many investors fall in love with ultra-high-yielding stocks. A high dividend yield usually indicates a low-quality, high-risk company. Most stocks with yields of 6% and higher are being priced for a dividend cut in the future. At minimum, they are being priced for lower dividend growth. A stock with a 2% dividend yield and 10% dividend growth will ultimately produce more dividend income than a stock with a 6% yield and 0% growth, and quite a bit more than a 20% yielding stock that will eventually have to cut their dividend. Don't fall in love with yield. You want sustainable, low-risk, predictable dividend growth for many years to come. Don't get too greedy for dividends now. Number 2, pay attention to payout ratios. Dividends ultimately are paid out of cash flows. A company that pays out more in dividends than it brings in will eventually be forced to reduce the dividend. Before you buy a stock, be sure to check the payout ratio. That is simply the amount paid in dividends divided by the earnings generated over the past year. A company with a payout ratio of 80% is paying out $8 in dividends for every $10 in earnings. A company with a 20% payout ratio is paying out $2 for every $10 in earnings. Which company will have more room for future dividend growth? It's the 20% payout ratio. Not only do they have more room to pay dividends, they also have more money left to reinvest in the business. A company with a payout ratio of 100% or more should be avoided. Unless earnings increase, the dividend will eventually be cut. Number 3, watch out for financial shenanigans. There are lots of companies out there that recognize how attractive the dividend is for investors. To support their stock price, they pump the dividend artificially. This can be done a number of ways. First, the company can issue lots of debt to maintain their unsustainable dividend. Second, the company can raise money by selling their own stock to other investors. This dilutes current shareholders and offsets, even completely eliminates, the value of the dividend. To find out if a company is issuing equity or debt, you can look at their financial statements. Those are available on many different websites, but I would suggest Morningstar for quality data over the past 5 years. Number 4, pay attention to stock prices. Investing is like physics. An object in motion tends to stay in motion. Research has shown that near-term price momentum over the past 3 to 18 months tends to continue. In other words, a stock that has been falling in value for the past year will likely continue to fall. This doesn't always hold, but plenty of academic papers confirm this phenomenon. The lesson for you is clear. Don't try to catch a falling knife. A falling knife is a stock that has been declining in price dramatically. Rather than buying them on the way down, it can be good practice to put them on a watch list until the price starts to show some stability or upward movement. These companies can often present good long-term opportunities, but near-term trends can be hard to break. Using some simple moving averages can help you with this. For example, let's say you identify a stock you really like, but the price is heading straight down. Put it on a list. When the stock price rises above, say, the 50 or 200-day moving average, consider buying it. Following this moving average strategy means you won't buy a stock at the absolute bottom, but that's not the goal. Your goal should be to get a good, not perfect, price. Whatever possible price gains you miss out on will be more than made up for by the number of doozies you avoid.